My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey folks, welcome back. Today, Sid Shamim is zooming in from Houston, Texas. Sid and his company, Headway Capital, are doing some pretty big things in the multifamily space. They've got a lot of projects on the go. They've got a lot of doors under management. And Sid was telling me a little bit off camera, they do something very interesting as well as a side project, which is working with, Sid, I believe did you call it micro hospitals?
Specialty clinics, medical.
Yeah, we'll touch on that as well. But anyhow, Sid, welcome to the show. Great to have you.
Thanks for having me, Dave.
Yeah. So Sid, give us a little snapshot of you and Headway Capital. Like what is like the 80-90 of your business, 80-20 of your business? What do you focus on primarily? What's your sweet spot?
Yeah. We mostly own apartment complexes between Texas and Arizona. I am from a corporate background working for oil and gas and started my journey back in 2011. Own a bunch of rental single family houses.
Yeah.
Moved up to apartments. My wife is a physician. So this firm is started back in 2011 with a singular focus of how we preserve our financial strength.
Yeah.
Today we own mostly apartment complexes about 3,500 units between Texas and Arizona, and then we also have one other asset class that we are actively looking into and actually acquiring is medical commercial buildings. That's a real estate name for it. But what we try to look for is micro hospitals or specialty clinics.
Okay, cool. Well, I'll circle back to that. Let's talk about the multifamily space for a little bit because a lot of folks are very familiar with that.
Yeah.
So 3,500 units, that's impressive. How many different properties does that represent?
I want to say about 27.
27?
27 individual assets. So average size for us is anywhere between, our lowest is 120 units and our biggest is 300 units.
Nice. Okay. So good sized properties. And these days, what is your ideal buy box? Like what does ideal property look like?
Great question. I'll just give a quick a background. So we started this journey in 2011. We all know what has happened between 2022, really, all the way to even today, right?
Yeah.
And it's kind of terrible to say, but we have not lost any of our deal. We have not lost any of our capital.
Well, that's not terrible to say. That's very good to say. A lot of people wish they could say that.
I think what I mean is, it's terrible as an example to put on your badge, right? So
we haven't lost any.
Yeah. We should be talking about, hey, we made this much, and we have done. I mean, I have at least three assets in my portfolio that are projected to do 4x on our equity.
Yeah.
When the timing is right, and then most of them are 2x or 1.7x on the equity. So that's mostly so. Given knowing what I just told you is like, this is what we have been sustaining. Last few years have been tough for everybody. What we're buying, learning from what we've gone through is we're purely focusing on really two approach. Either it's a brand new A-class asset where we are okay to pay a market price, still with some discount in today's market, or if it's a B asset, then we are really looking for price per door. We're looking for distressed asset, discounted projects that are discounted at least 20%.
So it used to be you're focusing more on value add type properties, and these days you want them pretty turnkey, if I'm understanding, or a big discount.
Both,
Yeah.
right? So discount on both. We're more aggressive on newer asset, but my career has all been into value add. And I was telling you off the camera as well. Sometimes I joke around that we're electricians and plumbers.
Yeah.
So value add is our niche right now. Nobody is looking at value add right now. They're all scared. And that's a great time for us to snap. Really
So you are still doing some value add in the B,
Yes.
the B side of things.
Yes.
If you get it at a good enough price.
Correct. And we are, most of our competitions are not looking at value add. To run value add, you got to know how to run an old car. You got to know the radiator, you got to know the tires and all of that.
Yeah.
And we have that skill set.
Okay, very cool, Sid. So a lot of operators, a lot of syndicators, they've had a terrible time over the last few years in the multifamily space. A good number of them have gone underwater, out of business, lost their investors a lot of money. You guys have made it through. What made the difference for you? What did you either do differently or see on the horizon, or was it a little bit of luck involved there?
Yeah. So I would say definitely luck.
Yeah.
But I think the biggest part that I knew from the get-go that when the tough time comes in, the operation matters, right? The operation skill set and how well can you increase income and reduce expenses will going to matter, right? So doing that part, we reduce our expenses by 27% on so many areas.
How much percent?
27%.
27%?
27% reduction in expenses.
Okay, so how did you do that?
Absolutely, yeah. So to give an example, our competition, they use third-party softwares out there. Give an example, a CRM to manage leads. They pay anywhere between $1,200 to $1,500 a month. We hired a team in Ukraine and we built our own CRM. And it's very easy. They all use, by the way, an underlier software. They white label it. We bought that software and we built it. We paid $125 compared to our competition. Then we also did a bulk agreement, master insurance policy.
Oh, okay.
That helped us a lot.
Insurance has been a huge expense for everybody. So
correct. And then we also we have our own strategy. Like, to give an example, in Texas, property tax is a big deal, and you got to protest those property taxes. A lot of operators cannot do it is because they don't have liquidity. Right? They're brand new in the business. They're trying to make a mark, and rightly so. I mean, I was in that shoe when I started. Initially, you don't have a liquidity. We try to stay liquid so that we can fight the property tax all the way to 2 or 3 years if needed to. Right?
So what's involved with being liquid for doing that?
Because if you're fighting for the property tax, let's say your property tax came out $1 million. I'm just using that round number. And if you're fighting it for $500,000, well, you got to still pay $1 million up until 3 years when a decision comes in. Right.
So you got to pay the property taxes until you can win the case.
Until you can win the case and get the money back, right?
Yeah. So
but until those 3 years, you got to pay those property tax.
Yeah.
And these are some of the operational strength that a lot of our we think we know. We learned it quick. We learned it because we've been doing it this time. And then we saw a couple of micro downturns in terms of COVID, and then there was a Harvey here in Texas, in Houston. So we saw those turnarounds, right? And there's some few of the expenses that I'm talking about. And there's a bunch that like, for example, we are paperless in our office. So our admin costs and paper costs and printers and rubbers and that's extremely low. Right?
So just lots of different things that save money here and there, and it doesn't seem like much on the surface initially, but it adds up to a lot.
It adds up quite a bit. And I'll give you another example on a lot of our property management firms. When you talk to them, they're putting a lot of responsibility, a lot of work on managers to reduce expense and things of that nature. We do it differently. We try to manage most of the costs on the corporate side. And our managers they're only responsible for 5 things, and we call it Big 5. Yeah. It's delinquency, your renewals, your marketing, your unit strategy, and your property condition. Right? Property condition, when I say work orders.
Yeah.
And that helped us to get them focused on exactly those 5 things.
The things that they can really control and
they control it. Like, for example, a lot of properties, they ask their managers to post all of the little invoices and things of that nature, and that's a distraction. Right?
yeah.
For us, we take care of 80% of the invoices. Our corporate office posts 80% of the invoices.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So are these managers on-site managers at each property? Is that what you're talking about?
Yes.
And you you have your own in-house
management. Yes.
Got it.
So our supervisors have anywhere between 5 to 8 property managers, meaning properties, sometime more depending on what's going on. So that's how, to answer your question, that was our strength that made us viable in that time. Mm-hmm. And then, frankly, we were also we in two specific cases, we had to inject some capital out of our own pocket. And I know a lot of operators, they don't do it or they don't prefer to do it. So
we're not able to do it,
or not able to do it. Yeah. So while I was, we had few properties that were in floating debt spiked.
Yeah.
While we were moving our way out of the floating debt to fixed rate or fixed debt. We ended up funding the gap to make sure that it's passing through. So, those are the things that really help.
Yeah.
And they're obviously a big factor of team, right? I mean, if I sit here and tell you that I wrote a check and everything was fine, that was not the case.
No, you had a lot of smart people working with you, coming up with solutions to these problems. That's really good, Sid. I appreciate that. Yeah, smart. Now, I want to touch on the whole micro hospital thing here in a minute, but first, I want to talk a little bit about capital because this is a very capital-intensive business. I'm not sure if you guys raise capital through syndications or a fund or some combination, but a lot of operators in the multifamily space these days are having a challenge raising capital due to all the challenges we just kind of talked about. Correct. What do you see personally like in the capital landscape in 2026?
In 2023, we did not purchase anything. We bought 2024, 2025. I was exactly your mindset, like, market will be tough, capital raising will be hard. Luckily, that was not the case with us. And I reflected quite a bit on this, at what was the catalyst, right? Why? I mean, we were able to raise about, in 2024 alone, about $12.8 billion. And then in 2025, a similar number. But I think the quality assets, a smart investor knows that this is a time to invest.
Yeah.
Right. This is time to buy, right? If when there's a saying goes, right? Warren Buffett, when everybody's greedy gets scared and vice versa. I think our communication was on point with our investors, existing and new. And then more importantly, we were buying those distressed assets below market out of foreclosure. So that story really helped. But if you ask me like exactly what helped, hard to say. I mean, and most of the time we do syndication by syndication, right? Like we do that by deal. We do have plan to get into funds, but not right away. My capital raising team, they're working really hard, to be honest. I mean, they make me look awesome in this camera right now, but there's a lot going on behind the scenes.
A lot of activity behind the scenes. Okay, well, that's good. Well, that makes a lot of sense. Like having, and that ongoing communication with people, like you're talking about, probably setting up realistic expectations, and then going after good deals, like you're getting properties out of foreclosure at a discount. That's huge.
Well, I think that in 2023, when we did not buy anything, we still continued our communication, our engagement with the investors. So, for example, in all 2023 and all 2024, we were doing once a month property tour for our own properties. So we invite our investors or new investors, hey, come visit our property, ask questions, ask anything you like to ask. So that kind of helped as well. So it was um, in my company, there's a term we use. We have 7 rules that we try to enforce in our team, and one of them is daily march, meaning if you try to run, if you try to go from point A to point B, let's say going from East Coast to West Coast in America, if you march daily, you will get there early. Versus you rest for 5 days and run for one day.
And sprint for a day and a half. And
Sprint for a day and a half.
So that steady Eddie consistency is what you're
correct.
talking about there. Yeah.
And that is how we structure internally as well. We've got our daily huddles for our sales team. We've got our L10 for our operation teams. It's I can tell you it's not easy to stay consistent.
Yeah. Okay. Well, those are some great tips there, Sid. So as we're wrapping up, I'm still curious. We're talking a little bit off camera. Your wife is a medical doctor by profession, if I recall correctly.
Yes.
And you've started to get into this separate asset class. Your primary focus is still on the multifamily, the apartment buildings, but you're also starting to get into a little bit of micro hospitals, I think, or medical type facilities. Tell me a little bit about that and what that's looking like. Yeah.
So we've been researching on this asset class, and I like it for 3 reasons. Number one, it's boring. Number two, is hard to understand, and number three, it comes under essential service. Right? If somebody's going through some medical condition, they're not going because of economy. They have to go. Right. And example could be an oncology clinic or orthopedic clinic or things of that nature. And the real estate name is medical buildings, but we try to focus on specialty clinics or even small community or micro hospitals.
So, what I've never heard micro hospital before.
Yeah,
what is that?
It's a fancy word of community hospital, small hospital, not in main town, but it's right in the suburb of the of a bigger city that caters majority of the population there, right?
So we might call it a clinic, something like that.
Yeah, so clinic. Hospital. Yeah, so this is a multi-specialty location clinic. You can call that. It has an ER, or if it doesn't have an ER, it has urgent care. Or if it's none of that is there, then they're the major footprint for any specialty clinic. Let's say you have to go to a GI, a gastroenterologist, for your endoscopies and colonoscopies, right? And those are the locations that cater the majority of the population there. Why we like it is because these are high caliber clientele in terms of tenants. We only buy the real estate. We don't buy the practice.
Yeah, you're not managing doctors.
We don't want to manage. We don't want to manage very, 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 very smart people. Yeah. I'm already managing one at home. So that helps us with. To me, the way I look at this business model, it's not going to be impacted right away in recession. It's recession resistant.
Yeah.
Nothing is safe in a recession, but this is something going to get hit really hard. And then these tenants, they don't move, right? Yeah. They have heavy equipment, a CT scan or scanner that you want to move, that's going to cost you $200,000.
Wow.
Just to move, right?
Yeah, just to move it.
Wow. Just move. And I've seen so many assets. If they are ever going out of business, they get merged or bought by a hospital.
Right.
Right. The only time that they're shutting it out if a doctor or a main physician passed away, right? Mm-hmm. So those are the reasons that I like it. Obviously, there are some risks as well. Nothing comes without risk. But I think in this case, for this particular asset class, I think the benefits outweighs the risk.
Very, very cool. How many of these facilities do you currently have in the portfolio? Or you just
We've got one. We've got just one, and we have a second one in our pipeline.
Nice.
The only thing that I'm not super excited about is that they're smaller size compared to multifamily size projects. So our strategy is a little bit unique, and we're very strategic about which specialty clinics we are trying to acquire. Mm-hmm. So it's a fresh journey. We started about 18 months ago. took me 12 months to understand and wrap my head around and understand the business, and before we can, bring it to our investors.
Yeah. Very cool, Sid. Well, hey, congratulations on weathering the storm in the multifamily and being ramped up to buy even more. And then it's very interesting what you're doing with these health facilities, these micro hospitals. That's very exciting. So I'm sure some of the folks watching or listening to this would like to connect with you. Where should they go to find out more about Sid and Headway Capital?
Yeah. Go to our website, headwayinvestments.com without an S. It's headwayinvestment.com. And that's the best way. If you want to schedule a call, my team can help. Just making sure if your listeners are understanding, one day we will bring a deal and we will ask you to invest, but that day is one day out of 300 days. The remaining 299 days, we add value. Our webinar is we do monthly webinars, and that's our goal, is to add as much value as possible. One day sale, 99 times nurturing.
Nice. Sid, thanks so much for being on the show. This has been great.
Thank you. Thanks, Dave.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.